With so much content out there, it can be difficult for beginners to get a grasp on what velocity banking actually is. So in today's video, we're going to focus on explaining velocity banking in a simple way and also cover off some of those common questions that come up when individuals start to learn about velocity banking. Be sure to stay to the end of the video where we share two crucial elements that are often overlooked when it comes to velocity banking and can be the difference between success and failure with the strategy. So before we dive into how velocity banking works, let's first take a look at the primary objectives of the strategy. And when it comes to velocity banking, it really aims to serve two main purposes: pay off debt faster and save on interest. So if the objectives are so clear, why can the strategy seem so confusing? Well, one of the main reasons is that velocity banking can be implemented in so many different ways, and it can be used to pay off a variety of different kinds of debts, such as credit cards, mortgages, auto loans, and even student loans. So it's important to understand that when you're looking at different examples of velocity banking, certain variables can make the strategy either look extremely beneficial or extremely detrimental. These variables can include things such as the type of debt a person has, how high their interest rates are, and what their income level is. Please note that in today's video, we will be looking at an example of a person using velocity banking to pay off credit card debt, but it's important to be aware that it can also be used on other kinds of debt, but different kinds of debts may have a slight variance in terms of how the strategy is implemented and how effective it is. So let's take a look at our example. Let's imagine that Phil currently has credit card debt. His balance on his card currently sits at $10,000 and carries an interest rate of 21%. The first thing that Phil needs to do to implement velocity banking is to gain access to some sort of line of credit. This could be something like a personal line of credit or a home equity line of credit. Some individuals with debt may already have access to a line of credit, and others may have to apply for one before they can implement velocity banking. This can potentially be a barrier for some people, as if they are not able to get approved for a line of credit, they will not be able to implement velocity banking. So let's imagine that in Phil's case, he does get approved for a personal line of credit, which will now give him access to an additional $3,000 in capital at an interest rate of 13%. So before we go any further, let's pause here and evaluate Phil's current debt. As previously mentioned, Phil's credit card currently has a balance of $10,000 at an interest rate of 21%. So Phil does not increase the balance on his credit card and just focuses on paying it off over, let's say, a 2-year period. At which point in these 2 years will Phil be paying the highest amount of interest? Well, that will of course be at the start of the 2 years, as this will be the point in which his balance on his credit card will be the highest. And the same thing goes for other types of debt. Just look at a mortgage payment plan and you'll quickly see that an individual's payment on their mortgage for the first couple of years is primarily just going towards interest and not equity in their home. So how can we help Phil immediately lower his balance so he's not paying so much interest at the start? Well, this is where his personal line of credit will come into play. Since Phil now has access to $3,000 from his personal line of credit, he can take this $3,000 and make a lump sum payment onto his credit card, which now will bring his balance down to $7,000 on his credit card. So now, instead of Phil having to pay interest on a $10,000 balance, Phil will now pay interest on a balance of $7,000. At his interest rate of 21%, this has now brought his monthly interest payment down from $175 to $122.50. But you're probably wondering, won't Phil just end up in the same spot because he will now need to pay back the $3,000 balance from his personal line of credit? Well, part of this is true, and that is that of course he will still need to pay back the personal line of credit. However, since his line of credit has an interest rate of 13%, Phil has now put himself in a better position as he's essentially transferred $3,000 of his debt to another kind of debt that has a substantially lower interest rate. But this isn't the only thing that Phil can do to lower the amount of interest he pays on his credit card. What he can also do is treat his credit card as if it is his bank account. And no, this does not mean make additional unplanned purchases on his credit card, but rather paying all of his expenses through his credit card. So to do this, Phil first needs to determine which of his expenses can be paid onto his credit card. Probably the most common expense that typically cannot be paid on a credit card is rent. In Phil's case, he has a monthly income of $4,000 and $3,500 in expenses. But from these $3,500 in expenses, only $2,500 are eligible to be paid onto his credit card, as his rent is $1,000 a month. So from his initial $4,000 a month income, Phil will need to leave $1,500 in his bank account. $1,000 will be used to cover his rent, and the other $500 will be used to satisfy his line of credit. This now leaves him with $2,500 in cash and $2,500 in monthly expenses. But before paying any of these expenses, Phil will take the $2,500 and put it all onto his credit card. This will further lower his balance from $7,000 down to $4,500. Now, instead of paying all of his monthly expenses, such as his groceries, subscriptions, utilities, and entertainment from his bank account, Phil will now pay these through his credit card. After paying all of his expenses throughout the month, this will bring his balance back to $7,000. So what was the point of Phil doing that if he just ended up in the exact same spot that he started? Well, although Phil still has a credit card balance of $7,000, he's also lowered a key metric that is used to calculate the monthly interest charge on his credit card, and that is his average daily balance. When banks calculate how much interest to charge a person on their credit card, what they do is they look at the balance on the card for each day that is a part of a payment period. So if we imagine that a payment period is 30 days, the bank will then take the balance from all 30 days and add them together. Once added together, the bank will then divide the number by 30, which will give us the average daily balance on the card for that 30-day period. This average daily balance is then used to calculate the interest that a person will owe at the end of the month. So in Phil's case, since all of his expenses won't be coming out at once throughout the month, this can help him to lower his average daily balance. The more expenses that Phil can pay towards the end of the month, the lower his average daily balance will be. To keep things simple, let's imagine that all of Phil's $2,500 in expenses come out equally throughout the month. This will leave his average daily balance at $5,250. Now, his monthly interest at his rate of 21% will be brought all the way down to $91.88. So let's pause here and see where this leaves Phil and compare it to if Phil did not implement velocity banking. With velocity banking, at the end of the month, Phil will be left with a balance on his credit card of $7,000 and his monthly interest charge will be $91.88. But Phil also took out $3,000 from his personal line of credit, which he will also need to pay back. From his income, Phil allocated $500 to pay for this loan. So this will now bring his personal line of credit balance down to $2,500. At his interest rate of 13%, Phil's interest charge for the month will be about $27. So if we add this $27 to Phil's credit card interest, his total interest for the month will be about $118.96. As we can see in this example, Phil has achieved the two primary objectives of velocity banking, which is 1, save on the amount of interest that he pays, and 2, pay off his debt faster. Phil is now on track to pay off his credit card faster and also has additional savings from his reduced interest charge, which he can now allocate towards making an additional payment onto his credit card. However, as mentioned at the start of the video, there are often key aspects of velocity banking that are overlooked. The strategy can seem like a no-brainer, but in reality, it's not. On paper, it can seem simple and straightforward, but when it comes to actually implementing velocity banking, this is a whole other situation. Successfully implementing velocity banking requires both careful planning and financial discipline. Without these two elements, the strategy will simply not work. All in all, when it comes to velocity banking, the general concept is simple: pay off debt faster and save on interest. But the reality is everyone's financial situation is different, and this can create complexity around the strategy. That is why it's important to never view it as a one-size-fits-all. Always speak with experts and do your own research before ever committing to something like velocity banking.